I will now leave the floor to our speaker and wish you all a very pleasant webinar. Nilanjan?
Thank you, Veronica, for the introduction. Good morning, all. It's a pleasure to welcome you to the transfer pricing webinar. Today, we would be discussing on a couple of things. One would be the OECD guidance, which has come up on transfer pricing on how to deal with issues concerning COVID-19. And we would also touch base on some other key issues that we have or that we face generally with intercompany services, transactions, royalties, etc. So let's get into the first part of the presentation. Although I have a set of slides for general reference, feel free to ask questions and so that it's not a monologue, we can have a discussion. So recently OECD has come up with a guidance on how to deal with transfer pricing. There are several issues which have with multinational companies have to deal with due to the impact of COVID, and one of them is cash crunch, a significant difficulty in managing the cash flow. So a lot of companies are trying to develop or implement strategies on how to have a good cash flow system in mind. Also, there have been disruptions in a lot of industries, which means that companies are looking at restructuring their supply chain management. This is something, it's also part of transfer pricing when we are saying that companies are looking at restructuring their supply chain management. A lot of companies are going from a physical model to an online model. So there's a lot of scope based on these things for companies to look at it. And before we get into transfer pricing compliance, there's a lot of scope of transfer pricing planning as a result of this OECD guidance which has come up. And there's certain things, certain questions, certain key things which I'd like to take all of you through. So let's get to the first question. A lot of companies are still operating with entities which are limited risk entities, like having contract manufacturers, toll manufacturers who have a very low risk and functional profile, and as such they are guaranteed a fixed return. This would work under a normal condition because the entrepreneur in the group, he would define the strategy, and at the end of it, if everything goes fine, he's the one who's going to get the residual profit. But if the strategy is not properly defined by the entrepreneur, he's the one who's going to bear the risk. But now what's going on is, due to COVID, it's not the fault of the entrepreneur in the group per se, but it's because of what's been going on. So we need to rethink on whether, entities which are characterized as limited risk entities can still get a routine return. So these models need to be looked at, because transfer pricing authorities everywhere in the world would ideally question if your limited risk entity is still getting a guaranteed return. And in terms that, because of COVID, there's no guarantee anymore. And also the limited risk entities have a small component of a local market, risk. So from that perspective, these entities are no longer get a guaranteed return. So any transfer pricing models or policies which have a limited risk distributor, limited risk entity, we need to look at it very carefully to see if the remuneration model is is in tune with what is happening in the market. How independent companies would deal with this situation. If an independent company operates as a limited distributor, how would it, I mean, deal in this COVID scenario? What kind of risk does it bear? Is it still getting the same kind of return? So these are some of the things that we need to look at in terms of looking at any transfer pricing policies which involve limited risk arrangements. Let's get into, the exceptional and how should operational and exceptional costs arising of COVID-19 be allocated between related parties. Because of COVID-19, there have been several, different categories of operational and exceptional costs. So the allocation is the key. And for the allocation of these costs, the allocation of risks is something which provides guidance, which says how it should be allocated, depending on the entities which are taking risk. If you take more risk, you get more profits. That is how it should work. And similarly, the operational costs and operational risk, these are to be allocated based on how independent companies would, deal in this situation. Transfer pricing is nothing. Is in the sense that it's comparing prices between related parties. However, the prices need to be at independent, at an arm's length, at independent terms. So we are still looking at independent companies for guidance on how operational and exceptional costs should be allocated between related parties. Also, I think related parties should look at the option of applying a force majeure clause. I'm sure this is something a lot of you might have already thought of or already are in discussions regarding this. Let's go to another issue which has come up from this guidance. We're talking about the force majeure, which affects the allocation of losses. Yes. So as per the guidance, we cannot automatically assume that a relevant intercompany contract which has a force majeure clause, it's sufficient to invoke that just because we have that clause. Nor it can be automatically assumed that in absence of such a clause, a renegotiation on the arm's length would be inappropriate. So, these are a couple of things we need to look at. Also the magnitude of disruption from COVID-19 is a key. Before we look at the force majeure clause, we need to assess the magnitude of the disruption that has been caused and accordingly decide whether we want to enforce that clause. Let's go into the next question. Under what circumstances may arrangements be modified to address the consequences of COVID-19? So we are talking about intercompany arrangements. So the guidance states that the determination of whether to renegotiate the arm's length should again be based on what independent companies would do. So we are still harping on the same point, saying that whether intercompany arrangements, intercompany pricing, intercompany policy should be modified. We should again take guidance from how independent parties would, operate in a similar comparable circumstance. Let's go to the next one. I'm sure a lot of you have very complex business structures, and many of you might have already applied for an APA. Some of you already might have an existing APA. And so in this case, an APA is nothing but an arrangement with the tax authorities saying that, okay, this is what I'm going to do. And because I've already agreed with you on on how I'm going to do the transfer pricing, you will not scrutinize me. Me and you already agree to the methods and the pricings But in case of, because of COVID-19, should that have an impact on the APAs? So as per the guidance, it says that for existing APAs, they should be respected, they should be upheld. There's no reason for them to be automatically disregarded or maybe looked at, I mean, to change anything in which has already been renegotiated. For that brings us to the next question, which is, does COVID-19 have an impact on APAs under negotiation? Here we would say that, I mean, because of what has happened is not a very regular occurrence, and it's has impacted the business so much. Both the businesses and the tax authorities, they need to be flexible and, I mean, collaborative in deciding how to approach the APA. I mean, the normal way might not work. We all need to be flexible. So one of the, I mean, options which has been highlighted is that we can do a short period APA for the period which is affected by COVID-19, and then go on and do a separate APA covering the post-COVID period. Yeah, I mean, for me, from a transfer pricing perspective, this guidance in relation to the APA negotiation, having two separate periods, one with which is affected by the pandemic, the other one which is post-COVID period, it makes complete sense, because the how business would operate is drastically different between the two periods, and therefore, I mean, we need to have, I mean, segregated APA, one, I mean, with considering the COVID-19 impact, and one without the COVID-19 impact. Let's go on to, I mean, now we are looking at some key guidance in terms of comparability analysis. Comparability analysis is something which is kind of a key for every transfer pricing report that you do. I'm sure a lot of you have already got consultants to do this job for you, but you still need to understand, and just for you to know stuff and review their works, so that you know that what they're doing is as per the guidance issued, or is as per something which is normally accepted by the OECD. The OECD is the mother body. It has a transfer pricing group which regulates transfer pricing all over the world, and the transfer pricing regulations all over the world, I mean, they're in line with the OECD. So let's get on with the first question. Can budgeted financial information be used to support the setting up of transfer pricing prices? So this is a potential, because of the impact of COVID, people are now looking at budgeted or forecasted financials. In this case, a potential approach for setting up transfer pricing would be to compare budgeted or forecast financial results to those actually achieved. So that, I mean, we know when we are setting the price that this is what the price would be if things would have gone as per budgeted or as per plan, and this is what has happened because of COVID. So the impact, we need to understand the impact of COVID, and this would give us a fairly good idea on when we are setting the transfer pricing. So there are a couple of things. One where we're setting the transfer price, one where we are testing the transfer price. Setting the transfer price is a mechanism where we are doing the policy, which is later going to be tested and questioned, I mean, by the tax authorities, for which we prepare compliance documentation. Yes. Let's go on to whether we can use outcome testing. So outcome testing is something is like for 2021, the analysis are made on financials from independent companies, but for 2020, the analysis would be made from analysis of independent companies, but those results are generally not available till late in 2020, maybe around October, November. So there could be a couple of approaches. One of the approaches is to look at historical data and do some kind of adjustment to factor in the COVID impact. Like if you are a production entity, if you have been impacted, you do a adjustment to say that I've operated at 70% capacity, so this is what my price should be. Or there is another option, which means you can do outcome testing. Outcome testing is after the year has passed and you already have information from independent companies for carrying out this transfer pricing analysis. You can then, determine the arm's length based on the information which has come in after the financial year has already been closed. So what we could do is we could then, as per the new information, we could do a primary adjustment. So we already have a documentation in place. We are saying this is our transfer pricing margin. My margin is 5%. And then based on, data for 2020, which is going to come in later in 2020 or in 2021, we can make an adjustment to have it more closer to what is actually happening with independent parties. Most of you would know that for transfer pricing, we utilize different methods. One of the most commonly method is the transactional net margin method, which involves use of various specialized databases. These databases collect information from various sources. However, the only drawback is that we don't have, year on year information sometimes. Like now for the financial year 2020, we still do not have a lot of information, from sample companies. So we looking at historical data, doing adjustment. Information in 2020 is only going to come in later on in the year. So there's a possibility, depending on how the results look, that we might need to do a primary adjustment. Let's move on to another question, which says, can we use more than one transfer pricing method? Of course, the OECD and even the local guidelines, they say that if the transfer pricing arrangement is complex, and if you think that it would be useful to corroborate or do a supplementary analysis, that is always welcome. It's quite a common thing. So and because of the circumstances that have been caused by the COVID pandemic, it is a very good option for you to have two methods to justify your arm's length. One which can be treated as the primary method, and one saying that this is my supplementary method or my corroborative method, and see, I am able to justify my arm's length through both of them. Also, let's go to the next question. Some of the, this has been a discussion point. Some of the consultants have been using data from earlier crisis, like from the 28-29 crisis, to make adjustments for COVID-19 pandemic. But the OECD guidelines is saying this is not really a good idea because of the unique nature of the COVID pandemic. So, it's not a good option that you consider data from those years to make an adjustment for COVID-19. Let's go on to the next question. Can roll forward approach be still be used? So for people who are not really acquainted with the term roll forward, it simply means that for the comparable companies that I have in the report, I do not do a full-fledged analysis. I just roll them forward in terms of looking at their updated financials and just updating their financial information, and that is it. But OECD is saying that this is not really a good option, considering that the companies that were identified in a different business environment. The conditions were not the same. So a more prudent approach would be to review those existing comparables and potentially do a new analysis, not just a roll forward. I mean, some of the consultants do that approach because it's easy, but it does present a lot of risk from a transfer pricing perspective, especially in context of COVID. Let's go on to another question. Can loss-making comparables be used? So in terms of using independent company data, because COVID situation has caused so many companies to make losses. Example, your company is the tested company for which we are preparing documentation. So because of COVID, it's okay for us to also include in our analysis loss-making companies. Previously, what might have happened, your company would be, I mean, profit making. So we would put steps so that we only have companies which have a profit, which companies with losses were automatically taken out. But now, because of COVID, we are saying that for us to have a more complete comparable analysis, we should also include loss-making companies. Yeah. This slide is quite important for most of you in terms of what are some of the key issues. So we need to look at realigning and reframing intra-group policies and intra-company agreements, which means that our parent might have a intra-group policy. So we still need to see if that policy is still applicable considering what has happened due to COVID. And if our intercompany agreement, whether it needs to be realigned, reframed because of the impact of COVID. Also, we need to realign some of the supply chain mechanism. Like a lot of companies have shifted from physical to digital platforms. So we accordingly need to do our intercompany agreements and our policies. Also, there are cases where some entity in your group is performing a value-added function. So accordingly, we need to do that entity which previously was not doing a value-added function, we need to remunerate that entity. So as per the function and risk profile of the company. Also, we need to look at royalty payments. In the past, it was quite common to have royalty payments involving a flat royalty structure. What do we mean by a flat royalty structure? I mean, it means just a flat royalty of 2% or 3%, but that's not going to work anymore. The applicability of those might be questioned. Then we need to look at the country by country filing reporting, which is extremely key for all the multinationals. And we need to be very careful on what information we are going to report, because this information is going to the tax authorities, and we don't want to present a very skewed indicator compared to the earlier financial disclosures. So we need to be very careful about what information we are disclosing in the country by country reports. Also, like we discussed in the initial part of the presentation, we need to look at the business models that are being used by various multinationals companies. Like some companies are still using toll manufacturer or a limited risk model, but those models might not be very relevant anymore because of what has happened with COVID. So these are some of the things which we need to look out for. This is something we should keep an open eye, so that we just don't go by what has been done in the past. We need to reframe our policies, and we need to realign our supply chain mechanisms as well. Also, during COVID, there might be certain entities within your group which might have offered you crisis management services. So it's a it's a fairly good idea from a transfer pricing perspective to have formal intercompany agreements with those companies and have them documented in your report. In terms of examining the financing structure, the financial arrangements should be renegotiated to obtain more favorable terms. I mean, most of the companies are looking at delay in interest payments or recategorizing short-term loans as long-term loans. So this is something which is okay from a transfer pricing perspective, because independent companies are also doing this. So this is something we need to look at, how we are renegotiating our financial arrangements, because a lot of companies are facing cash crunch. So a lot of them are looking, and they can't really pay out their interest. So a lot of them are looking to categorize their short-term loans as long-term loans, or looking at different other ways, like maybe doing a cash pooling arrangement where they can have more liquidity from resources within the group, so that they utilize resources within the group before they go out to an external lender. Also, in terms of a couple of last things which you need to watch out, if your consultant is still doing a comparability based on historic data, that might not be very relevant anymore. I mean, that might be relevant, but we still need to do some adjustments to factor in what has happened with COVID-19. Just an analysis based on historic data might not be relevant anymore. Also, we need to have a robust documentation in place to show how your business was impacted and how this has impacted the profitability of the other affiliates with whom you're doing business. This brings to the end the first half of the presentation. I'd now like to go on to the second half of the presentation, where we talk about other important considerations in terms of intragroup services and royalty payments. During this presentation, we will focus on those intragroup services which present the highest kind of risk. So before we go into it, we just discuss what is an intragroup service. An intragroup service is a service that has been provided by one member of a multinational group to other members of that group. It could be administrative, technical, financial, or commercial. As an example, a Romanian entity, which is a subsidiary of a Netherlands parent, might be getting a lot of these intragroup services. So we need to understand what intragroup services are and how payment should be made for these intragroup services. It's quite common for the tax authorities to look at these intragroup services, because often they feel that the recipient is not really getting a benefit out of it, and this is something which has to be demonstrated. Otherwise, they can disallow for the payment of that intragroup service. I mean, the example, if it's a Romanian entity who's getting an intragroup service from a parent, they should also be, able to demonstrate that this service is important to them and it clearly brings benefit to them, and they are willing to purchase these services even from a third party at the same kind of price. So this is something which we need to watch out for in terms of intragroup services. A couple of concepts which I quickly run through in relation to intragroup services is doing a benefit test. So the question of whether an intragroup service has been rendered should depend on whether the activity provides a group member with economic or commercial value to enhance its business position. So this is something we need to demonstrate as in the transfer pricing report, that this intragroup service has provided us benefit and commercial economic value. This can be determined by considering whether an independent enterprise in comparable circumstances would be willing to pay for this activity. Let's go to another related concept. So there are various types of activities or services which a parent generally does or undertakes for the group. So one of those is categorized or called a shareholding activity. It is something that the group parent would generally do because of its overall interest in the group as a capacity of a shareholder. This is not something which would be characterized as an intragroup service. And therefore, if we are paying for anything like this to our parent, this can be disallowed. Examples: costs that are ancillary to corporate governance of the group as a whole, something which is driven by the parent. Cost related to reporting requirements for the benefit of the parent company. So if these are some things for which we are in turn paying as a Romanian sub, this can be questioned by the tax authorities and disallowed. Then we go to duplication. Duplication is when, in general, no intragroup service should be found for activities undertaken by one group member that merely duplicates a service by another group member, or that is being performed by a third party. If there's any duplication going on, this is something which, I mean, we cannot pay for the same service twice, right? So if we are getting the same service from an independent party, we are paying him, and we are getting the same kind of service from our parent or our affiliate, this payment might be questioned. But in considering what duplication is, we need to understand. Here we will take a couple of examples. The first one being marketing services. So marketing services might have various levels. So just having marketing services from third parties and group companies will not make it duplication. We need to understand what is the category or what is the type of marketing services that is being rendered by both the parties before we go on and say that this is duplication. Similarly would be the case with IT services, because it also has different kinds of IT services. So we need to understand whether we are getting the same kind of services from an affiliate, from a third party, and if we are still paying for it. So, I mean, we need to consider, because these payments can be disallowed by the tax authorities. Then we are looking at another concept which says incidental benefits. There are some cases where an intragroup service performed by a group member, such as a coordinating cent, relates only to the group members, but incidentally provides you with some benefit. If, I mean, for example, there's some reorganization going on the group, and you get some incidental benefits from there, it's not considered an intragroup service, because these services are incidental. Also, if you're part of a group and your credit rating is high because you're part of a group, this is an incidental benefit. But if that entity is providing your guarantee when you're taking a loan, then it can be perceived as a service, because it is providing you an additional guarantee, and then it is okay for a Romanian sub to pay a guarantee fee. Let's go on to some examples just to make it, I mean, a little more clear. In this example, we see a Romanian sub pays for IT support that overseas headquarters provides to group affiliates. Meanwhile, it also engages third-party vendors to provide external IT support. So here, unless the Romanian entity can prove that the intercompany IT services are substantially different from the externally acquired ID services and are necessary for the Romanian entity, the Romanian tax authorities may view the intercompany services as duplicate in nature and therefore deem it as non-deductible and will disallow it. Let's go into services related to, this example relates to services relating to parent companies audit of subsidiary accounts carried out exclusively in the interest of the parent company. So if you see that this is already in the exclusively for the interest of the parent company, it shows you that it does not bring you any benefit for the Romanian subsidiary. So it does not make any sense to pay for these kind of services. All right, we go on to an example with ancillary services. So in this case, some MNCs may perform functions on behalf of the group according to their local requirement and allocate overhead expenses such as those related to accounting, human resource, to group members in other jurisdictions. If the services are represented by the overhead allocation are not intended for the benefit of the Romanian entity, there's no way that the Romanian sub is going to pay for it. If we are still going to pay, if there's still an arrangement where we are still paying for it, the Romanian tax authorities will view these services as non-deductible. Let's go and look a little bit at royalty transactions, because a lot of new guidance has come in for how to deal with royalty transactions. So royalties are nothing but payments of any kind received in return for the use of copyrights, scientific works, motion pictures, patents, trademarks, blah, blah, blah. One of the concepts that has come in for is extremely important for royalty transactions. I'm not sure if how you're dealing with your royalty transactions, whether we are still documenting royalty transaction based on previous guidance from OECD or just guidance based on the local legislation. But technically, because a lot of new guidance has come in, we need to base our analysis for royalty transaction by doing a DEMPE analysis. So what is a DEMPE analysis? So in the year 2015, the OECD came out with this BEPS action plan, which said that companies, before they decide on which entity is going to get the return from the intangible, they need to do a DEMPE analysis. So DEMPE is D is development, I is improvement, maintenance, protection, and exploitation. So previously what happened, the companies which were the legal owners of the intangible would automatically kind of get all the returns. And a lot of documentation in the past was still based on just this: okay, I am the owner of the intangible, I get all the return. But now if we still persist with such an approach, this is going to be questioned. So we need to look at who's carrying out the development activity, who's doing the improvement of the intangible, who's maintaining the intangible, who's protecting it, who's exploiting it. So we need to basically figure out which entity is doing what. If our parent is doing development, improvement, if we are doing maintenance, protection, exploitation, which entity is doing what? And then accordingly, we have to do an analysis, and it could be that both entities should get a return from the intangible, not just the parent entity because it's the legal owner. That doesn't work anymore. So we need to understand if the Romanian sub is doing any of these, and accordingly the remuneration model has to change. I'll not take you through the framework. This is just a thing. Let's jump into some examples from a license fee royalty, also considering the DEMPE thing into account. Payment of a royalty fee. I mean, expenses incurred on outbound payment of royalties can be questioned. I mean, this is really, really common for this to be questioned by the tax authorities. So what we need to do, the Romanian payer needs to prove that it provides a clear benefit from the intercompany licensing transaction, and the royalties or license fee that it is paying is not excessive as compared to the benefit that it receives. If the Romanian authorities feel that you're not getting a benefit and there's no clear benefit from the intercompany licensing transaction, and if you're not able to clearly demonstrate in your transfer pricing report that there's no clear benefit, they can disallow payment of royalties from, for example, a Romanian sub to a Netherlands parent. Let's take an example with specific focus on royalty payment for technical IP. So Romanian entity might have licensed technical IP which related to older technologies. But these older technologies are no longer providing you with the latest or cutting edge. The tax authorities might say you can get similar or competing technologies from third parties at a significant lower price. So why are you still paying your parent or your affiliate for the technical IP, which is no longer providing you with the cutting edge? In such cases, the Romanian tax authorities might argue, saying that the value of the IP has diminished and the current value of the IP does not justify the same amount of royalties being paid. They might also say that, why did you not look at other realistic options? Rather than just going with your group company, you could look at other realistic options in the market. And if you have to pay a lesser royalty, authorities would be much happier because lesser money is going out of Romania based on payment of royalties. So there's a similar example with royalty payment for marketing IP with brands, trademarks, and trade names. Sometimes what happens is our parent is a big name, but it does not have it's not very well known in the local market. It's not really well known in the Romanian market. Does it still command a payment of a big fee for the brand or a trademark? So this is something we need to consider. I mean, we need to see if only by using that trademark, what are the perceived benefits we have. If we are not able to demonstrate again in the transfer pricing report that there's no perceived benefit, just some big name is coming and I'm paying royalties for using his brand, it doesn't make sense if you're not able to demonstrate that you're clearly getting benefits. Let's do an example with DEMPE. Like I explained, with the DEMPE regulations coming in, legal ownership of IP does not determine, all the returns. We have to see which entities are doing, developing, enhancing, maintaining the other functions. And there might exist situations where the legal owner of IP resides in a group affiliate outside Romania, but the IP is deployed in the Romanian market. The Romanian affiliate participates in the development, enhancement, maintenance, etc., etc. So the Romanian entity, although it's a sub, it's playing a more important role. So from that perspective, the legal owner might still be the parent, but I am the economic owner because I am doing the enhancement. I am doing most of the functions. So I should be accordingly remunerated for some of those functions. And it doesn't work if we just stick to our previous model when all the returns just go to the legal owner. Sorry. The attribution of economic ownership has two implications for Romanian transfer pricing. When a Romanian taxpayer makes a royalty payment to an overseas affiliate that is partially owned by the Romanian payer, the Romanian authorities might challenge the full deduction of royalty. Second is Romanian taxpayers may consider the Romanian tax authorities may consider the Romanian taxpayer has at least partial economic ownership. So they want money to come into Romania so that your taxable base increases and it's better for them. And also, I mean, from an economic perspective, if the Romanian entity is doing some of the DEMPE functions, it should be accordingly remunerated and because it is becoming the economic owner, if not the full economic owner, it is partially becoming the economic owner. So these are some things which need to be considered when we are doing our royalty analysis. The DEMPE is something which is extremely important. Like I said, we cannot just stick to what we had in the past. If we have any such agreements which are just saying that we need to pay a flat out royalty to our parent, I mean, we need to look at it very carefully. We need to look at the fact that the Romanian entity could also be involved in a lot of the other functions like development, maintenance, enhancement. So we should not forego that amount of commission or that amount of licensing fee that should actually come in for you. So this is the key that we should consider, because if we do not examine this in great detail during an audit, the tax guys might, and they might say, okay, you just looked at what we had in the past, you gave all the money to the legal owner, but Romania is doing so many things, so it's not fair on them not to get any returns. So accordingly, we need to be very careful when we are doing transactions relating to royalties and license fee. These are some of the things that we need to keep in mind. Some documentation which has to be maintained in this relation should demonstrate that the service fee has been rendered and the benefit has been conferred. Also, the documentation should clearly demonstrate that this provides you economical and commercial value and it improves your operational efficiency. Whether there's any duplication of rendered services from rendered owner compared to local service provider, local service recipient business functions, and documentation for non-duplication is really, really important. So that brings me to the end of the webinar. Feel free to ask questions.
Thank you, Nilanjan, for this detailed presentation. We don't have at the moment any questions on the chat, but if any of our participants would like to unmute themselves and intervene with a question, they're more than welcome to do so.
I am also happy to receive any questions on my email ID. The idea was to introduce the participants to some of the things that they should watch out for. I'm sure a lot of them already work with transfer pricing consultants, but it's not enough for them just to, I mean, rely blindfoldedly on your consultant. You should know what they're doing. So that was the whole idea. This is for you to understand that this is something that you should look out for. So when you receive the deliverable or the documentation from them, these are, I mean, it'll be easier for you to review because you now kind of, I mean, know a little more stuff in detail and you know what to look out for. And you also know that this is something that, what are the risks if I just go by something which was okay in the past, if I don't consider the new regulations which have come in, if I don't document how the COVID-19 has impacted my business or how COVID-19 has impacted my intercompany transactions, because it's not okay just to be I mean, doing things which were okay in the past, because the business is changing. COVID-19 has brought about so many changes. So we need to be flexible as well.
True. If you, dear participants, will have questions after we close the webinar, you can just drop them in an email to us at info@nrcc.ro, and we'll make sure to forward them to PKF Finconta, to Nilanjan Nag, and make sure to get the answers that you need.
I'll be happy to have a chat with any of them. I mean, feel free to drop me an email or schedule a call. And I'm happy to explain in further detail, because some of these things might be a little technical, it might be difficult in the first time to gauge all the things. So I'm happy to have a conversation with the participants.
Thank you for your availability and for your time and presentation today. This brings us to the end of the webinar and to the end of this NRCC Taxation Week. We thank you all for joining us this week, and of course we hope to see you back online to our future events. And also we are happy to welcome you in person to our in-person events. We actually have one this afternoon in Cluj. It's the NRCC dinner. You'll find all the details on that on our Facebook page. So if you're in Cluj, make sure to visit us. Thank you all for your time. Have a great day and see you back at our next event. Bye-bye.
Thank you, everyone. Thank you. Bye.